Hi, everyone, and welcome back. We're diving deep today into the world of nested transactions.
Ooh, nested transactions.
Yeah, have you heard of those before?
Well, I mean, I've heard of them, but I don't know, like, all the details about them.
Right. Yeah, it's kind of like a hidden world that exists beneath like those everyday online purchases.
That's interesting. I mean, like, how hidden are we talking?
I mean, they're pretty hidden, like most people don't even realize that they're happening, and we're going to be focusing specifically on master submerchant models.
Okay.
And I think you'll be surprised by how much this impacts like pretty much every corner of the digital economy.
Okay, so, like, online shopping and stuff like that.
Yeah, exactly. Like pretty much any time you're buying something online or even like using certain banking services.
Wow. So it's more common than I thought.
Yeah, it's way more prevalent than most people realize. And what we're going to kind of try to unpack today is the fact that like while these structures are designed for speed and efficiency, they also create like these unique vulnerabilities,
Oh, okay. I see.
especially when it comes to like tracking money.
Interesting.
Yeah. So like to kind of set the stage here, can you maybe give us a quick overview of what these master submerchant setups actually look like in practice?
Sure. Yeah. So imagine like a big online marketplace,
Okay.
kind of like a digital department store.
Gotcha.
That's the master.
Okay. The
And
max.
then picture all the individual vendors that are like selling their stuff within that marketplace.
Right.
Those are the submerchants.
Okay.
And so this model basically allows these smaller businesses to tap into a much wider customer base.
Right.
And they can also leverage the master's established infrastructure
For
for things like payments processing and, other logistical stuff.
right. So it's like kind of a win-win for everyone, right?
Yeah, exactly. More
Mhm.
choice for consumers, more opportunities for businesses.
But you're saying there's a catch.
Well, yeah, there's always a catch,
All
right?
right, lay it on me.
The catch is that these arrangements often involve a whole chain of transactions
Oh.
where funds are actually passing through multiple intermediaries
Okay.
before they reach their final destination.
So wait, are you saying that when I buy something online from like what looks like a single store, my money might actually be bouncing around between like several different companies behind the scenes?
Yeah, that's exactly what I'm saying.
And that's what you call nested transactions.
Yes, those are nested transactions, and they can make it really tricky to kind of track everything and make sure things are running smoothly.
Okay, so tricky in what way?
Well, it becomes incredibly difficult to trace the origins and purposes of funds when they're moving between so many different entities.
Right, I can imagine.
It's kind of like trying to follow a single thread through like a giant tangled web.
Oh, wow, that's a good analogy.
Yeah, and this is where the risks start to emerge.
You're making this sound pretty scary.
Well, I don't want to scare anyone,
Yeah.
but it's definitely something to be aware of.
So just to be clear, you're saying that even like big financial institutions are struggling to keep track of where the money is going in these situations.
Yes, it's a real challenge for everyone involved.
That seems bad.
It raises some fundamental questions about how we ensure like financial security and trust in this digital age.
That's a big question.
It is a big question and one that we need to start addressing more seriously.
Okay, so let's get into some specifics here.
Okay.
What are the actual risks that we're talking about when it comes to nested transactions?
So one of the biggest issues is the lack of transaction visibility.
So, like, we can't see where the money is going.
Exactly. When funds are constantly moving between multiple intermediaries, it becomes really difficult to get like a clear picture of the money trail.
Okay.
And this can create these blind spots where like fraudulent activity or money laundering can go undetected.
That's a scary thought.
It is a scary thought.
And I'm guessing this makes like compliance a nightmare for everyone involved.
Oh, absolutely. It's not just about like tracking the money itself. It's also about verifying identities and making sure that everyone involved is who they say they are. But when you have these multiple layers of entities, the potential for like gaps in identity verification and documentation increases significantly.
So it's like a game of telephone
Yeah, I like that.
where the message gets distorted with every whisper.
Exactly. You never really know if what you're seeing at the end is the original information.
And that can have real consequences, right?
Absolutely.
What kind of consequences are we talking about here?
Well, it could mean that unauthorized individuals are gaining access to financial services or that due diligence checks are being bypassed.
Okay, so we're talking like real serious stuff here.
Yes, this is serious stuff.
It's starting to feel less like a deep dive and more like a plunge into the financial abyss.
Well, I guess every deep dive has its risks.
But we're just getting started, right?
Oh yeah, we're just scratching the surface here.
All right, let's take a quick break and we'll be right back to explore this even further.
Sounds good. Yeah, so where were we?
We were talking about how nested transactions can create these like gaps in identity verification and basically make it really hard to know who's actually involved in a transaction.
Right, right. And that lack of transparency can have some pretty serious consequences, like we were saying.
Yeah, for sure. And it seems like it would make it almost impossible to like monitor these transactions in real time.
You're exactly right. That's another major challenge with nested transactions.
Okay, so it's not just that it's hard to trace the money after the fact.
Right.
It's that we might not even know something fishy is going on until it's too late.
Yeah, it's a real concern, especially in the world of digital finance where everything moves so quickly.
Right.
Like fraudulent schemes can evolve and adapt really fast.
So we've got limited visibility, we've got challenges with real-time monitoring,
Ah.
and then there's the whole issue of accountability.
Oh, yeah, that's a big one.
Like when something goes wrong in a nested transaction, how do you even figure out where the breakdown occurred and who's ultimately responsible?
It can be a real nightmare trying to untangle that mess.
Okay, so you mentioned earlier that this impacts a wide range of institutions.
Right.
Like it's not just a problem for like small businesses or fintech startups.
Yeah, not at all. This is something that affects all sorts of financial players.
Can you give us some specific examples?
Sure, let's start with correspondent banking relationship.
Okay, correspondent banking.
Yeah, so this is basically where one bank provides services to another bank,
Okay.
often in a different country.
So like Bank A in the US needs to send a payment to someone with an account at Bank B in Europe.
Right.
So they use like Bank C as a middleman to facilitate the transaction.
Exactly. And these relationships are essential for global finance.
Right.
But they can get really complex when nested structures are involved.
Okay, so walk me through that.
So you might have Bank A working through Bank C,
Okay.
who in turn relies on Bank D and so on.
Oh, wow. So it's like a chain of banks.
Yeah, it can be. And each additional layer just makes it harder to track the flow of funds and ensure compliance.
So even if Bank A has like really strict compliance measures in place,
Right.
they could still be unknowingly facilitating illicit activity if one of their correspondent banks isn't as diligent.
That's the risk.
Okay, so that's correspondent banking.
Yeah.
What about like these new fintech companies that are offering banking services?
Right, you're talking about banking as a service or BOSS.
Boss. Yeah, that's
No.
the one. I've heard a lot about that lately.
It's a rapidly growing sector for sure.
It seems like every tech company wants to get into financial services these days.
Well, it's a lucrative market,
Right.
but it also comes with its own set of challenges, especially when it comes to nested transactions.
In what way?
Well, think about it. You have these fintech companies that are managing thousands or even millions of customer accounts.
Wow.
And all of those accounts are linked to a bank's core systems.
Okay.
So it creates this massive web of nested transactions
And that's a problem because
because it introduces a huge potential for what we call cascading risk.
cascading risks. Okay, I'm not familiar with that term.
So basically what it means is that if one partner in the boss chain becomes unstable, whether due to financial difficulties, operational failures, or compliance breaches,
Right.
it can trigger this domino effect that impacts everyone connected to that network.
Oh, wow. That's unsettling.
It is. It's a real concern.
So it's starting to sound like the more interconnected our financial system becomes, the more vulnerable we all are to these hidden risks.
That's a very astute observation.
And we haven't even talked about like third-party payment processors yet.
Oh, right, the TPPs.
Like PayPal, Stripe, Adyen, all those companies that seem to be involved in like every online transaction these days.
Yeah, they're everywhere.
They must have a nightmare dealing with nested transactions.
You would think so, wouldn't you?
I mean, it just seems like there would be so many layers of complexity.
There are. It's a real challenge for them to maintain visibility and control over the entire payment flow.
Okay, so give me an example.
So let's say you buy something online from a small business
Yeah.
that uses a payment platform provided by Company A.
Okay.
Company A, in turn, might rely on Company B to process the actual transaction,
Right.
and Company B might work with another bank behind the scenes.
So even though it looks like a straightforward payment, to me, the money could be passing through several different hands before it reaches its final destination.
Exactly. And that layering makes it incredibly difficult for the TPPP to track the ultimate beneficiary of the transaction and ensure that everything is above board.
And that creates more opportunities for fraud and money laundering to go undetected.
Unfortunately, yes.
Okay, so we've got traditional banks, fintech startups, payment processors.
Right.
Who else needs to be worried about nested transaction risks? Are we missing anyone?
We can't forget about money services businesses, or MSBs.
Money services businesses, MSBs?
Yeah, these are companies that provide services like currency exchange, money transfers, check cashing.
Right, right. So like the kind of places you might go to send money to family overseas or cash a check if you don't have a bank account.
Exactly. And MSBs often operate through networks of agents and subagents,
Okay,
especially when they're dealing with international transactions.
got it.
And this can create a real labyrinth of nested transactions.
A labyrinth. Wow, that sounds complicated.
It can be, which makes it extremely difficult to monitor the flow of funds and ensure compliance with anti-money laundering regulations.
This is painting a pretty bleak picture.
I know, it's a lot to take in.
It sounds like nested transactions are creating this whole new level of risk that traditional financial safeguards just weren't designed to handle.
That's a valid point.
Is there any hope here? Are companies and regulators doing anything to address these challenges?
Yeah, there's definitely hope we're not heading for a complete financial meltdown or anything like that.
Okay, good, because I was starting to get a little worried there for a second.
I know it can sound pretty alarming, but the good news is that there's a growing awareness of these risks, and we're
Mhm.
starting to see some concrete actions being taken to address them.
Oh, okay, that's good to hear. So what are some of those actions?
Well, for one thing, some institutions are getting a lot more cautious about the companies they partner with, especially in the bar space.
The banking as a service space.
Right, exactly like you mentioned Green Dot Bank earlier. They actually made a strategic decision to move away from certain boss relationships that they deemed just too risky from a compliance perspective.
So they were basically like the potential benefits aren't worth the potential headaches and the potential damage to our reputation.
Yeah, pretty much. And Wells Fargo has adopted a similar approach.
Mm-hmm.
They're being very careful about who they partner with in the boss world because the regulatory scrutiny is just so high right now.
Right. So it's kind of like a better safe than sorry situation.
Exactly, especially when you're dealing with other people's money.
For sure. For sure. What about on the technology side? Are there any new tools or solutions emerging to help companies manage all this complexity?
Absolutely. There are a lot of companies, particularly in the payment processing space, that are investing heavily in enhancing their compliance frameworks.
So, like, who are we talking about here?
Well, companies like PayPal, Stripe, Adyen, those are some of the big players, and they're implementing more integrated solutions for things like transaction monitoring, identity verification, document management.
So basically, they're trying to get a clearer picture of what's happening at each layer of a nested transaction.
That's the goal.
Mhm.
It's all about bringing more transparency to the process, kind of lifting the veil on those hidden layers.
Makes sense. And what about regulators? Are they doing anything to address these risks?
Oh yeah, definitely we're seeing increased regulatory focus on these issues.
Okay, so give me an example.
Well, just recently, the Federal Reserve mandated that Evolve Bancorp Inc. improve their risk management programs related to fintech partnerships.
So they're basically saying you need to step up your game when it comes to managing the risks of nested transaction.
Exactly. They found deficiencies in their policies for overseeing these relationships, and they told them they need to fix it.
That's good. I mean, it's good that regulators are taking this seriously.
Oh, yeah, absolutely. And the FDIC is also taking action. They recently proposed a new rule aimed at enhancing record keeping for custodial deposit accounts.
Custodial deposit accounts, remind me what those are again?
It's basically an account where someone holds funds on behalf of another person or entity.
Okay.
And this proposal is specifically focused on situations where non-bank companies are accepting deposits from consumers and businesses.
Which they often do through partnerships with banks, right?
Exactly. And the FDIC wants to make sure that they have the information necessary to quickly identify and protect depositors in case a bank fails.
So it's about making sure there's a clear paper trail even when multiple parties are involved.
That's the idea.
Okay, so it sounds like there's a lot of work being done to address this issue, but is it enough? What does the future hold for nested transactions and the risks they pose?
Well, it's a constantly evolving landscape for sure, but I think we'll continue to see a big focus on collaboration and information sharing between financial institutions, regulators, and technology providers. We need to develop more sophisticated solutions and standards to ensure transparency, accountability, and trust in the digital financial ecosystem. And we're starting to see some companies emerge that are specifically focused on addressing these challenges.
Like who?
Well, there's a company called Arvo Comply, for example. They offer a really comprehensive suite of tools that are designed to help institutions manage the complexities of nested transactions.
Interesting. And how do they do that?
They provide things like enhanced visibility across all the layers of a transaction end-to-end identity verification and real-time monitoring.
So they're giving institutions the tools they need to stay ahead of the risks.
Exactly.
Well, it sounds like there's reason to be cautiously optimistic. We're starting to see some real progress in addressing these challenges.
I agree.
But this deep dive has definitely opened my eyes to a whole new level of complexity in the financial system. It's kind of mind-boggling when you think about it.
It's a lot to wrap your head around.
So for our listeners out there, the people who might be listening to this while they're commuting to work or making dinner, what's the key takeaway here?
I think the main takeaway is that nested transactions, while they enable incredible innovation and financial inclusion, also present some unique risks that we need to be aware of.
Okay.
It's a reminder that even the simplest online purchase can involve a complex chain of intermediaries behind the scenes.
Right.
And as consumers and users of financial services, it's important to be mindful of where our money is going and to ask questions about the security measures that are in place.
That's a great point. And it leaves me with a final thought for our listeners to ponder. Knowing what you know now about nested transactions, does it change how you think about your own financial interactions? Do you feel more empowered to ask questions and demand more transparency from the companies you do business with?
I hope so. I think knowledge is power in this case. The more we understand about how these systems work, the better equipped we are to protect ourselves and make informed decisions.
That's a great note to end on. Thank you so much for joining us today and for shedding light on this complex and often overlooked issue.
It was my pleasure. Thanks for having me.
And to our listeners, thank you for tuning into this deep dive into the world of nested transactions. We'll be back soon with another fascinating episode. Until then, stay curious and stay safe out there.